Okay, chapter 7 is titled Portfolio Policy for the Enterprising Investor, the Positive Side. And in this chapter, Graham continues his discussion of portfolio management for enterprising investors. He argues that enterprising investors can also take a positive approach to investing here by actively seeking out undervalued stocks and investing in them with a margin of safety. So again, kind of a repetition of some points he made earlier in the book, but with some good additional nuggets and slight nuances. So I was talking about it. So again, margin of safety, difference between the intrinsic value of a stock and its market price, and buying and investing in stocks and selling for less than their intrinsic value. He argues that enterprising investors can aim to achieve higher returns, again, while minimizing risk, which is kind of the point. And in this chapter, he introduces a technique, what he calls cigar butt investing, which is, I don't know if it's stuck around, but that's kind of got a nice ring to it, which involves investing in stocks that may have been overlooked by the market. So you kind of look in an ashtray, I guess, and you pick out a cigar butt that looks like it's still got a little juice left. Maybe is the idea for the metaphor there. This approach is similar to what's now known as value investing. So again, buying the stocks that have been beaten up, and people are think they're down and out, but you as an enterprising investor see some value in them, and for where the price they're at, you're willing to invest in them because you think they can recover to a level or kind of grow at a steady rate that the market doesn't fully appreciate. And he argues, though, that cigar butt investing is not a long-term strategy. It is only effective for short-term gains. And that's kind of, what we, I guess, are called now as the value trap, right? So you want to identify stocks that actually have value and avoid the stocks that look like they may have value over time but are actually value traps. It's kind of like when you decide to do a renovation on a house or an apartment or something like that, and you think it's going to be one thing, and you think you're going to put some money into it, and you put some money into it, and you think you can turn around and sell it for a profit, and then you realize you can put a little bit more money into it, a little bit more money into it. So I think that's that's a money trap, I think they call it. So that's a similar concept here with the quote unquote value trap. So I think a nice quick chapter, but really does do a good idea of introducing this idea of a value trap, which he calls the cigar butt investing, which we now know, like I said, is the value trap. So that's chapter 7. Again, valuable insight into how enterprising investors can take a positive approach to portfolio management, combining both qualitative and quantitative analysis, which again, he goes really another key theme throughout the book. So that's chapter 7. We're getting there. We're almost halfway through. So let's get on to chapter number 8. All right. Hello, everyone. We're here with chapter 8 of The Intelligent Investor. The investor and market fluctuations. We're here at the Knowledge is Money channel, and chapters 5 and 6 seem to get a lot of interest. So hopefully we'll keep going here. And I got some feedback from people that the shorter chapter summaries are working well. So I'm glad you're enjoying that. And again, a lot of relevance in today's markets with everything that Graham is talking about in The Intelligence Investor, with inflation, the conflict in Ukraine, the up and down roller coaster ride of the market in 2023. Stocks were up out of the gate, and now they've been down in the last week, and it's just it's up and down. So the volatility is certainly there. So chapter 8, let's just get into it here. I got my notes as usual. I'm just going to pull them up. So chapter 8, like I said, the investor and market fluctuations. And in this chapter, Graham discusses the importance of market fluctuations and that volatility I was just talking about. And more importantly, it's not the fluctuations, it's how you react to them as an investor. And he starts by saying that market fluctuations are a natural part of investing, can't be avoided. Market's going to have gyrations, market's going to be volatile. It's just, again, back to that knowledge and awareness. It's just you need to be aware of it and have a plan for how to respond when it happens. He emphasizes that investors should not be influenced by market trends or short-term price movements when making investment decisions, and instead focus on the underlying fundamentals of the companies that they're investing in. and make informed decisions based on their long-term potential. And again, remove that emotional element out of it from the decision-making process and just rely on the facts. It's really, really important lesson here, and just in general for investing. He also notes that investors should be prepared for the market fluctuations, and again, diversifying portfolios, right? So if you have all your eggs in one basket and that goes up or that goes, down like this, the market gyrations are going to be worse. They're going to be, exasperated. Whereas if you have your eggs diversified across several baskets, if one goes down, it doesn't bring the whole portfolio down as much. He also here tries to warn against market timing, so trying to time the market. And then again, the idea of, are you an investor? Are you a speculator? Investors invest for the long term. They really don't invest day to day, right? They don't try to say, okay, what's the market going to do tomorrow, and how can I benefit from it? That's just like going to a roulette table and putting it all on black, or just flipping a coin and betting on the outcome, right? Really just invest for the long term, invest using facts, take emotion out of it. A lot of the key points that we've hit on before, but he really kind of brings it to life in this chapter. And, don't be surprised when the market crashes. And don't be surprised when the market goes up. Don't get too high and too low emotionally in either scenario. Just stick to your plan. And if you do that, you will be an intelligent investor over time, like he says. And hopefully that knowledge is money, and we're the knowledge is money channel. And so that's chapter 8. Thanks for listening.